change, deforestation and pollution. Social issues can include modern slavery and child labour. And governance issues can include executive remuneration and gender diversity. What sustainable investing seeks to do is invest in companies with strong, sustainable characteristics.
Is sustainable investing increasing in popularity?
So over the last decade, sustainable investing has become increasingly important, and there are now over $1 trillion of assets invested in a sustainable manner in Australia. There are a variety of reasons why investors choose to invest sustainably, and that can be to align their investments with their underlying values and beliefs, to diversify their portfolio, or to reduce risk. At Fidelity, our view is that by investing in companies with strong standards of sustainability, we can protect and enhance returns for our clients and contribute to a more sustainable financial system for society as a whole.
Some great insights there. Thank you, Katie.
Thanks, David.
Look out for more of our sustainable investing insights with Fidelity or visit
Five-star investing starts with NabTrade, proud sponsor of The Call. Find out more at nabtrade.com.au/The Call.
Good afternoon to you. It is the 27th of August, a Friday afternoon. I'm Nadine Blayney. Great to have you here with us for The Call. 10 companies over an hour picked by you and 2 expert guests to analyze those companies plus the stock of the day. And also a warm welcome to all of you joining us via Facebook, via Twitter, and YouTube as well. We do this program every day between Monday and Friday. And it's also, in case anybody didn't know, available as podcast form if you'd like to catch up with it after the fact. Excuse me, let me introduce my guests today. It's going to be a good one. Because they both come at the markets from a different perspective, generally speaking, but they're both crazy about ASX listed companies. We have joining us Jun Bei Liu from Tribeca Investment Partners and also Carl Capolingua from ThinkMarkets, who's joining us live from Perth. Good afternoon to both of you. Today, Jun Bei, we find ourselves pretty much at the end of reporting season. What do you think?
I was just thinking, phew, finally, I will come towards the end of it. This is probably the first reporting season I've gone through that we are working from home. And for me, it was homeschooling my kids at the same time. So it's been thrilling and it's been great fun. And look, I think all in all, the reporting season has been pretty good. More companies met their expectations than missed. And although we have a few companies talk to high cost and investments and the like, but that's good for future growth. So all in all, good reporting season with lots of income, a lot of special dividend buyback coming from corporate Australia. So, it's been a healthy reporting season.
Healthy, that's a good word to describe it. Now, Carl, I'll look forward with you because, of course, it's all about what comes next and plenty of people already turning their minds to what could potentially be the next catalyst for this local market. How has the index performed through reporting season and how does the momentum look from here?
Yes, good afternoon, Nadine. Look, the index has taken a little bit of a pause, a little bit of a breather over the last couple of weeks. But I think that's mainly to do with external factors. So probably not as much to do with earnings season, but more to do with what's going on in America with the Fed and the tapering and just a general probably switch to risk off on the back of what's going on in China with commodity prices as well as falling Australian dollars. So a few things external to earnings season, but earnings season on the whole, I think, was fairly supportive of the index. I think what's going to be supportive going forward, you asked me that question, well, what's going to be the next catalyst is, well, we saw this big special dividend by Wesfarmers today. We saw a number of special dividends throughout the earnings season and some buybacks as well. So if you put those two things together, the first part of the dividends is the ex-dividend date where the stock prices are going to fall. I mean, that's inevitable and that's going to take index points out. But as those dividend checks start to hit bank accounts in a couple of weeks from now, that money will have to be reinvested back in the market. And I say have to because there's not a lot else you can do with it right now. So we're not going on overseas holidays. We've probably already upgraded our big screen TV and we're certainly not going to leave that money in the bank earning next to nothing in interest. So by my calculations, around about $50 billion, maybe a little bit more now with this Wesfarmers special, is going to be hitting those bank accounts pretty soon. That's got to be reinvested back in. That's about the market cap of Woolworths trying to get into a market which is already, experiencing limited supply at the moment. So I think there's definitely some upside coming from there. And then the buybacks, that's just underlying bid tone to a lot of our big blue chip shares as well. So I think it's still positive to come.
Okay, yeah, just reading some analysis in terms of the US reporting season, which did demonstrate a lot of the same characteristics as our own, saying that the uptrend remains intact as profits justify the buy the dip mentality that is out there. Now, Carl, I will start with you on the stock of the day. Koshi's had a bit of a big cap theme going this week, so who am I to change it up on a Friday? I thought we'd look at Wesfarmers off the back of the result that you did reference there. So a 16% spike in annual profit to $2.4 billion, revenue surging. On the lockdown, though, impacting group sales, and they're already seeing that in the first little bit of FY22. And last I checked, so this is at just past the noon hour here in Sydney, Wesfarmers down by 3%. So Carl, you're a Perth boy. Why I'm starting with you. The market is choosing, at least right now, to focus on what's to come, not what's past, correct? What did you make of the result and where to from here for Wesfarmers?
Yeah, definitely. So, look, a great result, a solid result, and the sort of result we've come to expect from Wesfarmers with this sort of conglomerate model where they've got all these different pieces of the puzzle all working together to deliver them, great numbers, and that is obviously a reflection on management's ability to pull that off, and that's very impressive. So, you're definitely paying for quality here and sort of sleep at night factor, but unfortunately, having put all of those wonderful things on the board, we then have to look forward, and half of their stores are closed. Basically, if you're looking at Kmart, Officeworks, Bunnings, I guess Bunnings is still open, of course, isn't it? Essential services, but that's going to take a chunk out. And when we first came into these lockdowns, there was great hope that it would be a few weeks or a week. Maybe some optimists were thinking. Now we're a few months. We're going to knock out the first quarter for the most part, certainly in New South Wales. So it's going to have an impact on the bottom line. They're not making it up. We're not seeing that huge surge in home renovations that we saw at the start of the pandemic back in 2020 from Bunnings. We're not seeing this huge switch to work from home that's helping Officeworks and Kmart to some extent, because we've done all of those things already. We're not seeing this big switch to online sales that's helping catch. So yes, unfortunately, markets look forward for Wesfarmers, and that's why the share price is pulling back. It's pulling back from a point where the shares weren't exactly cheap anyway. Mm-hmm. But look, having said that, I think if you've got it, I think you should hold it. The chart looks really, really, really strong. There's always ebbs and flows in any trend. It's a wonderful long-term uptrend. It's pulling back, sure, but don't panic. I think there's going to be lots of support around that sort of 59 to 60 level. And by my valuation anyway, we've got a sort of a fair value target around that $63 mark. So I think you're starting to get some value back in it there, and it would be a buy in that zone for a longer term portfolio holder.
Well, Jun Bei, that's what I was going to ask you, because most talk to the quality aspect of Wesfarmers, the diversification. I mean, it's primarily Bunnings and the retail arm, but there is some diversification in there. So on a pullback such as we're seeing today, could it be a buy?
Look, there's no denial that Wesfarmers has the best retailer. Bunnings is probably one of the best retailer around the world. It's done incredibly well, but don't forget it is mature. So today the pullback we're seeing in Wesfarmers, if you look at over the 12-month or 18-month when we had the whole COVID disruption, it's not much of a pullback at all. In today's market, that people are paying a lot for so-called quality companies, and but at what price? Wesfarmers at this point is trading on the forward earning of close to 35 times. Now, traditionally it trades about 20 and at a premium to the market, now to 30, close to 35 times. And its earning in the next couple of years are going to fall, simply because they were the big beneficiary of the government stimulus towards consumer, towards the home builders. So there was a lot of home construction activity that boosted the Bunnings earnings. Now, so these earnings are going to fall, and you're paying a big multiple on what is a peak earnings. So, so to me, I think in the next 12 months, the capital is better allocated elsewhere. There's a lot of blue chip quality business that earning has been impacted by COVID, such as Ramsay, and then it's on 24 times when all the other healthcare businesses trading on 40. So so I think this is a market that you see a lot of quality business. You do need to take a longer term view, and then work out what is the right value for this business. So for Wesfarmers, my view is that it's probably not going to do all that much in terms of share price, and your capital is better allocated elsewhere.
So that's a sell then, Jun Bei. Best is
I will put that's a sell for me, and put into the company like Ramsay.
Okay, that's a bonus buy, people. I will tell you that. Ramsay Healthcare, in the wake of its results this week, Jun Bei, no doubt has just run the numbers, so there you go. And just as a PS, we'll be speaking with Rob Scott, so we'll find out where to from here. Huge comps they're cycling through. Where's the growth going to come from next? That's from 3:30 Eastern right here on AusBiz. Let's get to the companies that have been picked by our viewers, shall we, guys? And I will start with you with this next one, Jun Bei, because you just mentioned the healthcare space, ResMed. So Charlie has written in and saying, look, I'd like an expert opinion on why it's worth $285 US in the States, because of course we've got a listing for ResMed in the US where it's $39 around about there here. Big difference in price. Jun Bei, you can address that and then we can talk about ResMed as an investment.
Of course, look, the differential is that the US is just a piece of the Australian business, and there's currency involved, and there's number of shares that are linked to Australian shares. So it work out to be very close to parity if you adjust it for currency and number of other issues. So, if it works for you, you can buy in the US or buy in Australia. The price differential is very minimal. Now, I hope it's not my bird in the background. And now, in terms of the investment itself, ResMed is a very high quality business, and it has done well throughout the pandemic. And now that more recently, in the last 3 months or 4 months, its competitor Philips actually had a product recall. Now, ResMed and Philips pretty much dominate a very big part of the market globally and the US as well. And when Philips recalled their product, now ResMed's product pretty much couldn't keep up with the demand to fill up that that gap. Now, share price has pretty much put up, significant amount of value on the back of the competitor product recall. Now, this recall is not going to, come back, or Philips is not going to be able to refill all these products for another perhaps 6 to 12 months. So, there's a bit of time to run. However, just remember, billions of dollars has been put on the market cap for ResMed. While it's a really high quality business, it's whether they can keep some of those market share over the long run is going to take time to work out. So meanwhile, I think ResMed is a hold for me. But my view is that it is over 40 times earnings in next 12 months. Other places in healthcare, we talked to Ramsay is, it's cheap and it's reopening. And even CSL is looking more interesting as well at this point. So for over 40 times, it's more of a hold for me than a buy.
It's a bit XC. And is that how you would view ResMed as well, Carl?
No, well, not necessarily. No, I mean, there's certainly the chart has taken off. Jun Bei mentioned that that was on the back of the Philips recall. Mm-hmm. And yeah, I mean, markets look forward and they make those adjustments. But you have to understand that the market's probably made the adjustment as well. So then they have to prove it. Where some brokers are saying, well, it's a 5% permanent market share. Well, prove it. Time needs to pass to see that come to fruition. But typically stocks at the bottom left, top right. That's where I do most of my business, and that's what I like to buy. And you could argue that the stock has moved, but you would have to also argue that the people who are buying, they're still buying today. I mean, they're buying today not because they think the stock's going to be worse in 12 months' time. They're buying today because the stock's going to be better. At the same time, the only way you get a chart that's bottom left, top right is if very few people want to sell. So it's a double-edged sword here. Yes, people are buying. We know that the chart's going up. But at the same time, very few people are selling. How do you know? Well, the chart's going up and the people who want to buy have to pay more and more. So the reason why people aren't selling is the same reason why people are buying. They think the price is going to be higher in 12 months' time, and I'm happy to back it on that basis. Yes, it's trading at about 40 something times earnings. I can't remember. I have to check my notes, but there's going to be some good growth in the business, sort of mid-teens to high teens, and that brings that PE down over the next few years. I can't say whether it's a better buy or worse buy than some of the other healthcare stocks. I'm looking at the stock on the basis of ResMed and the opportunity that it presents now. I would love to buy pullbacks on this one. I think you're probably going to get those opportunities. I think it might be around that sort of 37, 38 mark, but we're thinking that it could get into the mid 40s on the back of these recent developments. So it's a hold if you've got it, and it's a buy and pullbacks if you don't.
Got it. Thank you. That's ResMed for Charlie. For Sarab, the next company on the list is Zipco. It was a big week for earnings coming from the buy now, pay later space, Zip and Afterpay. And Sarab says he's intrigued by Zip. Is there any point getting into it following the recent results and also the Afterpay news, which I'm assuming he's referring to Square's big buyout of Afterpay. Is it just game over for these small players? And that's what a lot of people are questioning. Is there enough room for all of these buy now, pay later plays in the US? Jun Bei, is Zip itself a potential takeover target?
Oh, look at they all takeover targets. I think what's interesting is that Zip itself, it could be simply because they zip together, with Afterpay and the Sezzles. They all have created, enough of a platform, and they have all moved incredibly fast to have joint venture, to have capital partner, to have potential big platforms where they can grow into. Now, Afterpay obviously has moved very fast and captured a lot of market. And now that with this Square opportunity, certainly take them to the next level, because Square has millions of merchant accounts and things that Afterpay can just bolt straight onto it. And then also Afterpay offers a great opportunity for Square as well. So does that threat to the growth of the likes of Zip and the others? No, I don't think so. But what it does show is that competition is picking up, you need capital to grow. So equity market has been great for those businesses to raise equities and to continue to expand, and most of them have a lot of capital. But look, to thrive and to become the leader, in this space, ultimately you have to spend and grow rapidly. You cannot sit back and trying to reap the margin, or trying to grow your margin and things to cut the cost. That just will not work at this point. So to me, Zip needs to move fast. They need to continue to invest to keep up. I still think Zip is a hold. It's all about how you capture the next stage of growth.
Hold for Jun Bei for Zip. Now, Carl, plenty of action from all of the buy now, pay later space in the United States. Zip is looking to rebrand its QuadPay business that it bought there to Zip. Some say that's a bit of a risky move because QuadPay does have a brand already in existence in the US. You can talk to this company fundamentally or just via the charts. Do you think there's any reason to buy Zip?
Not on the chart, no. I think there's some reasons to consider on the fundamentals, ironically, but the chart is saying that regardless of what I think, the market is quite nervous about this one. You can see straight away on that chart, it's trading at the bottom end of the range over this calendar year. And again, the only way you can get down there is if there's a lack of confidence in your future prospects. So we can debate as much as we like what we think about these companies, but at the end of the day, the market will decide whether we make money or lose money out of those opinions. And you look at the price action. So in this, I'm talking about peaks and troughs, and we've seen consistently lower peaks. We are seeing a consolidation zone around $7, but I always liken this sort of a chart to the bouncing ball. So if you get yourself a tennis ball and try and bounce it off the edge of a table, so it hits the table once, twice, and then misses on that third go. And that's kind of what we're seeing here, where each bounce is getting lower and lower as gravity takes over. And the gravity here is just this decreasing confidence in the story going forward, which is potentially punctuated by this Afterpay and Square deal. So look, for me, I can't be a buyer. I think I think this is potentially a takeover target. I mean, not even potentially. I think this is kind of the most logical path forward for Zip now, is to find a bigger partner to attach to. I agree there's some risk with rebranding to QuadPay. But look, I'll cut this a long story short, I think, Nadine, is what you want me to do, and say that if I had it, I'd be very, very nervous right now, because if it breaks through 650, I think there's a bigger fall to come. If I didn't have it, no, I can't buy it.
Would you sell it now?
I'm very close. If it breaks 650, I think you need to be out of it. Yep.
Got it. Thank you. Now let's go on to number 3 on the list from our viewers. And this is Marley Spoon. Ticker code MMM. This is for Kai. Look, the report was headlined by 36% growth in revenue, growing its subscribers, but it is spending big to get there, and it's not looking to slow down that spending either. We did do an interview with the Australian CEO of Marley Spoon. It's up on the website if anybody cares. Jun Bei, look, it's another competitive space, isn't it? You've got HelloFresh, you've got Marley Spoon. We were at home cooking a whole lot more. Do you think that these types of companies, particularly Marley Spoon, can continue that momentum as potentially things return to normal post-pandemic? Jun Bei.
Yeah, look, that'll be interesting. Yeah, that's a really good question. It's a very interesting concept and a really interesting space because these businesses, essentially, they're actually not competing with the takeaways and takeouts. They're actually trying to grow or take share from the supermarket, fresh food space, where they actually pretty much repackaging the fresh food and then sell it to with a recipe to individuals. So it's a very interesting concept, and I think innovation in that space is and given how fast they're growing, certainly has a space, and future may look quite different from what it is today, but there's definitely a space. And Marley Spoon obviously has a link with Woolworth, which does show that the giant does believe there's a future in this sort of space. Now the problem with this business model is that huge amount of consumer will try. But the thing is, there's also quite a big portion of people only try for a little bit and then they will stop using. And once they stop using, they won't come back for a very long time. Only something like 20-30% of people that initially tried will stay on for a long period of time, and their basket might grow and things. So for this business, that they need to keep spending to grow new consumer, just simply because the churn is always going to be very high because 80% of people will drop off. So so to get that return, we will have to see how it goes after the COVID. Certainly the every company that spend on those digital marketing and things have talked about increased expenditure, and this business is not any different. At the same time, it had a lot of COVID related supply chain disruptions, lack of labor to deliver things. So there's been a lot of those challenges. So to sum it up, I think it's a little bit early for me. I think there's a future for this business, but I have to observe to whether they can sustainably generate the return per dollar invested on marketing.
So this isn't a void for now, but it's one that you'll watch. Jun Bei. Carl, what do you think of?
Probably just watch and see.
Just watch and see. Yeah, got it. Carl, I'm just one person, but I kind of agree with Jun Bei's point. I know that even in our little office here, there's been phases where people sign up for these sort of programs and then they drop off, and they've done it because they've got a referral code and get a bit of money back, yada, yada, yada. We all know the story. So if we've got the fundamentals sort of laid out, if you see it dramatically different, let us know. Otherwise, what's the price action telling you?
Yeah, price action doesn't look good, and reflecting perhaps a little bit of reality setting in for this one after a huge run through COVID or early pandemic times. So all the gains came from April through to October, when there was a whole heap of uncertainty and potentially people extrapolated way too far into the future the potential demand for this type of a concept. I saw an interesting little statistic that they had in their recent results, and it said, Nadine, 40% of people struggle to create a meal plan for the week or something along those lines. And I read that and I thought, that means 60% of the people have no problem at all. And that's probably a little bit of a dilemma for a company like Marley Spoon. Just talking to the price action, I should also say that they've pumped out a lot of discount vouchers over the last 6 months, and that's their growth and increase their costs as well. But looking at the chart, it is, I think, at a very important crossroads now. So we had that huge run up from COVID, and it has effectively flattened out since then as sellers have come in and to take those profits. But that selling, that extra supply in the market has not been overly absorbed and met by demand, by new true believers coming in and saying, you know what, this is on my radar, and I think it's going further. It got on a lot of people's radar, but not a lot of new money has come in since then. It looks like it's breaking down, and when I say that, the long-term trend is now turning from an uptrend to a downtrend. It's broken below some key support levels, and instead of getting back above them quickly, it's actually resisting beneath them. So it's trying to get above, and it's getting pushed back down each time. I'm very concerned about it. There is a little bit of a hope around about that 180 level, and if it stays above that and you're a holder, you can maintain that hope. If it gets below 180, then I think it's going to fall a long way. So it's definitely not a buy for me. It's not quite a sell yet, but below 180 it will be.
Thank you, Carl. All right, next on the list is ServiceStream, SSM. This brings us back to reporting season. Well, have we ever really left it so far? Not really. Underlying earnings from operations at $80 million, in line with what was pre-guided to the market. No dividend because, of course, it's bought this non-core services business from Lendlease. So now it is diversified across utilities, telcos, transport. Jun Bei, do you know the company? Do you like the company?
Look, I know the company, and I don't like it that much. I will probably say it's a void for me. It's mainly because, look, it's just a little contractor, and not just. It's a contractor that help installing lots of different things. And now, over the last few years, it has made good money out of a lot of NBN rollouts. So, pretty good margin and things. Now, but the challenge with contractor is that, one is NBN is sort of rolling out. You need to have new segments to grow those earnings, because contractors, you don't have the contract, you don't have any revenue. So it was actually, it's a right strategic thing to do for them to buy the Lendlease services. Now, whether they can integrate it properly, it seems like a good fit, but we're not sure. We need to see how they integrate it, whether it can really drive growth and things. But it certainly helped alleviate some of the concern for the earnings hole that's coming up in the next few years. So it's not expensive. It's less than 10 times. It's 9 times. And the result itself is not flash. So, for me, I do have a preference for quality business that have a franchise that has consistent business, earnings growth. And, this business just doesn't kind of sit there.
Got it. Now, I'm not a charts expert by any stretch of the imagination, Carl, but when we had them up on screen, I wasn't overly impressed. You?
No, not at all. We saw that big drop. There was a big drop late last year, and that's when they lost some major contracts, as in it was 30% of their revenues. So from, I think it might have been Telstra, but don't quote me, because it's 6 months ago now, and look, they haven't really recovered. So Jun Bei's right. We want to buy. Typically, we want to buy companies that are growing their earnings and growing their earnings consistently, or at the very least, we can see those earnings going to grow into the future. Look, past is the past. I think they're probably going to steady the ship. I think there is going to be some growth in the business. I do like this Lendlease Services acquisition, although they didn't exactly get it at a bargain, but I think it makes a lot of sense. And there's a lot of demand out there for infrastructure type assets. We know, these big pension funds are falling over themselves to buy these assets. Well, you need somebody to service these assets, and that's where ServiceStream comes in. So look, there's definitely a case for it, but I can't get past the chart. The valuation is okay, but not knocking my socks off. I think I've got a fair value target of about 91 cents, which gives it about 6% upside. And with that chart, still top left, bottom right, which is the opposite of what I like to say, I have to avoid this one as well.
Ian, that's for you. ServiceStream, SSM is the ticker code. Don't forget that this is not for your personal circumstances. This isn't financial advice. This is information only, and you still do need to consider your own circumstances. Halfway, almost, we've got Phil, Spirit Technology Solutions, ST1. Again, I spoke with the CEO this week. This is a telco, essentially, services provider as well, and it is profitable. So it's moved from consecutive years of losses into profitability into FY21. A lot of its customers are sort of non-discretionary, health, education. They've recently done an acquisition late last year to get into cybersecurity, so they'll be able to provide their customers with some cybersecurity protection. And some out there say that it's a takeover target to boot. Jun Bei, what do you think of Spirit Technology Solutions?
Yeah, look, I must say I'm not too close with the business, but I had a look at the, what it does and things. It certainly seems like a pretty stable business in a heavily M&A sort of driven sort of market. So it may well become a target, and simply because market is really consolidating in that space. It's not expensive. It's on something like 14 times. So sounds reasonably cheap. Look, and also it does have a little bit of reopening play to the story, because the East Coast SMBs has been sort of impacted, because of the disruption. So that potentially have a lot more, earnings growth to come through. I would still avoid at this point. Simply, I see this business doing okay, but nothing really, that's significant to really drive me to, put capital in there. The acquisition they made potentially could do quite well. We certainly have to wait for more time to see the execution and things like that. So I'm probably staying on the sideline for this one.
On the sidelines, Carl, Spirit Technology Solutions. To Jun Bei's point, it has made a lot of acquisitions. It has been integrating them into the business. Do you know the company?
Yeah, look, it's a very dynamic company, and they're very active, aren't they, in terms of gobbling up smaller companies, integrating them within the broader spectrum. And the goal has been for a number of years to provide this sort of holistic approach to your telecommunications and IT needs. So you mentioned cybersecurity. That was their most recent acquisition. It's a pretty important piece of the puzzle. And it does now give them this sort of one-stop shop benefit now for small to medium enterprises, but they're looking to scale that up as well. So look, I like it. Fantastic growth coming through the business, and I can't see any reason why that's not going to continue. It does make money, which is so unusual for some of these small technology plays on the ASX. It's cash flow positive. Those cash flows are increasing. It's got a PE. I can value it. I think it's, this looks really, really exciting. I did my valuation on it. I came up with 68 cents per share, which the company's less than half of that at the moment. So either this is the biggest bargain of the century, or I'm completely wrong on this one. And hey, only time will tell. Now, a couple of points that I'll make on this for you. Now, there are a bunch of shares in escrow that have come out and are coming out, and that could explain why, despite me thinking this is fantastic, there is still some overhang on the share price. So to the order of magnitude of about 30 million shares, yes, 29 million shares that came out on July 1. And if you look at the chart from July 1, it's been heading down. We've got another 8 million shares coming out on September 1 as well. And these are, when you make all those acquisitions, Nadine, you typically like to do it with a little bit of cash, but mainly a lot of stock. All right. Mm-hmm. And the founders in those businesses, you might say, well, if this company's so great, why are these people selling? Surely they would hang on. No. See, they got into their businesses at a much, much better price. So you're relatively speaking, they might be in from 3 cents a share. So at 30 cents a share, it's a no-brainer there for them to sell some, pay off some debts, pay off the mortgage, buy a new house, buy a BMW, whatever it might be. So I wouldn't panic too much on that. Look, as much as I like it, and this is where the rules come into it, as much as I think this is a bargain, the chart says you have to wait. And I'll give you some points here to watch, because I'll be watching this one very, very closely going forward. I think we're getting pretty close. Around that 25 cent level, there was a nice bounce just at the end of June. If we can get another bounce from there, and if it can then move back above about 33 cents, that's when I think you jump into it. Until then, you don't have to do anything. Just be like me and just watch. And you might say, hey, Carl, why would I wait until it gets to 33 to buy if it's going to get to 25? And I say you need to do that because you need to be sure that all of that selling overhang is out of the market and that there's enough demand to take it up to the next level. So that's the way I would play this one.
Rule books. All right, Phil, hope that helped you. And if you'd like to listen to the interview with the CEO, again, it's up online. Look, we've reached the halfway mark. We're doing pretty well, I think, for time, guys. Let's summarize the first 5 stocks plus the stock of the day. Stock of the day, Wesfarmers. Look, Jun Bei says that it's a sell, and she's given you an idea if you'd like to redeploy the capital for larger gains going forward. Of course, it's a quality company, but she says it's not cheap on forward earnings of about 35 times. So it's a sell and put your money potentially into Ramsay Healthcare. It is a buy for Carl, though, because he says that it looks as if, according to him, that it will, it's a buy if it's between 59 to 66. It's a hold if you've got it. It's a wonderfully long-term uptrend for Wesfarmers. ResMed was the first company on the list. It is a buy on a pullback for Carl between $37 and $38. It's the kind of chart he loves, bottom left, top right, that hockey stick pattern. It's a hold for Jun Bei. Again, it's pretty expensive on forward times earning, quality business. But can it keep the market share? She again is pointing to Ramsay and potentially even CSL looking pretty good right now. Zip is the next on the list. It's a hold from both of my guests. Carl wouldn't be buying it on the chart. It is showing decreasing confidence. Look, Jun Bei just says to continue to grow, it needs to spend to grow rapidly. And that's just something you need to keep in mind in terms of these buy now, pay later companies and the consolidation that's still likely to happen. Marley Spoon, look, it is a watch and wait for Jun Bei. It's got its challenges. And again, the business needs to keep spending to continue to grow and maintain its subscriber base. Carl says that the price action is not looking very good. And so, he's not liking this one as a buy. Now, Service Stream, look, he says that it looks as if the company is looking to steady the ship, but Carl says he just can't get past the chart. And it's an avoid for Jun Bei as well. She doesn't like it that much. It's not expensive, but she wants to see the integration of this buy from Lendlease before she would consider taking a deeper dive into the company. Spirit Technology Solutions, Jun Bei would like to just avoid this one for now. It looks like a stable business, not expensive. But she wants to see how the execution of these businesses can continue. Carl, I saw a smile on his face when I was introducing the company. He genuinely likes it. It's making money. He thinks it's really exciting, but he's laid out the confines as to when you should buy in. You just heard them. So it's a wait for Carl right now, but he kind of likes it. I really got that feeling. All right, we've got our own portfolio on the call. We've been tracking it since July 1st of last year, thanks to our partner NabTrade. So when two companies get a 2 thumbs up from our guests, has not happened today, as you know, it gets put into the portfolio. And let's check in on how we've been performing. So weekly, we're up around 1.6% on the month, up over 3.5%. Year to date, just under 4.5%. But since its inception, the call portfolio is up 41%. And both of our guests have contributed to this call portfolio. I will say that. Jun Bei Liu from Tribeca Investment Partners and Carl Capolingua from ThinkMarkets. Some of the companies we've added lately: ReadyTech, Unity Group, Beacon Lighting, Macquarie Telecom, and MSL Solutions. Out of the portfolio lately, Flight Centre, Vanguard Global Value Equity, Active ETF, Western Areas, and Jensen Education. Interesting. If you'd like to see what's in, what's out, you can go to ausbiz.co/portfolio. And just a reminder, we'd love it if you could tell your friends about us, and to help you along that line, we've got a bit of a prize pool in action. The details you can find via the T&Cs on the COB newsletter. And if you don't subscribe already, you can subscribe at ausbiz.co/join. Back to the list. My guests have had a bit of a break. I'm going to start with you on this one, Carl, just to switch things up a bit. This is a question on Grange Resources from Annette, who says, look, she's been looking at the half-yearly result. She says the dividend yield is nearly 8% fully franked, but the share valuation is less than 3 times earning multiple. Why is this iron ore pellet producer so undervalued or unappreciated in the market compared to other iron ore producers? Carl.
Yeah, quite a great question from Annette, and I'm so glad that I get to participate in answering this one, because it helps me make some really pertinent points for investors. So we heard earlier on about Wesfarmers, and it was trading at about 30 times earnings, and yet we've got Grange here trading at I've got it trading at just under 2 times earnings. So how is that possible? How can Wesfarmers be trading at 30 times earnings, yet Grange at 2 times earnings? Grange has a dividend yield of around about 7%. Wesfarmers has a dividend yield of around about 3%, both fully franked. So it just kind of just doesn't make any sense, does it? But I think you have to compare like for like here. So, Grange is an iron ore miner. So first of all, let's not just consider a 2 times earnings per share, 2 times multiple. Let's consider it against other iron ore miners, okay? So let's not consider it against the rest of the market. I don't think that's the right way to do it. And if we do that against, say, Fortescue, for example, Fortescue's trading on around about 4.5 times this current year's earnings. So now it starts to make a little bit more sense straight away. We're not in the 30s or ever going to be in the 40s. It's just not where this is going to be. And of course, then you have to consider, markets look forward, not backwards. So markets are saying, well, is the iron ore price going to stay where it is for the foreseeable future? And I think most analysts, including myself, would agree that it's not going to be around $200 per tonne next year or the year after or the year after that. It's probably going to be closer to $100 a tonne, or maybe $120. And that's what markets are factoring in down the track. So yes, it might be 2 times this year's earnings, but it might be 5, or 8 times or 10 times earnings in, say, FY23 and FY24. And investors, portfolio managers, are looking that far down the track. And so you have to take that into account as well. So the question is, I think, more about should it trade on 2 times earnings in absolute terms, or should it be about 2 times earnings compared to Fortescue's 4.5 times earnings? And there are a number of reasons why it should be not as attractive as Fortescue. So it is a bit of a one-trick pony. It's got a single mine in Tasmania. There are a number of operational issues around that mine. It's an aging mine. It's got a lot of infrastructure and a cost associated with it. And they're a very, very high-cost producer compared to, say, Fortescue, which is a very low-cost producer. So I actually think it's priced correctly. Having said that, I still think iron ore stocks are cheap in general, and this one can do very, very well. Last time I was on the call, the stock was 30 cents. I called it a buy. It went to 90. It's back to 60. What do you do with it? I think that's where you go from here. I think on a valuation basis, I'm happy to hold. On a chart basis, it is looking a little bit shaky, so I'm a little bit nervous there. But I do think there's this huge area of support around this sort of 55 to 60 zone, and I'm a holder on the basis that that zone will hold, but I can't be a buy yet until I see it actually hold. So that's where I'm at.
It is a hold. Thanks for that, Carl. Yep. Jun Bei, do you have anything to add? I would be interested to get your view on iron ore miners now, iron ore price. I was surprised to hear Carl say that some of them are undervalued.
Yeah, look, iron ore has come off quite a lot. We're not talking about, well, obviously our iron ore prices went to $220, but they crashed down very quickly to the 150 and even going lower. So, just on the basis of potentially a little bit slower growth, and China sort of slowed down somewhat. So all of that together, it certainly means the iron ore miners' share prices come off a lot. So, with this little one, it's on a good dividend yield, but look at Fortescue. Fortescue is on a dividend yield of close to 20%. And even just this final dividend, you gross up the franking credit, it's 17%. And they haven't paid it yet. So if you want dividend, you can get it. But I think, I'm constructive on iron ore miners. I think China will gradually, they started already stimulating the economy. So generally the experience is that once they start stimulating the economy, we will see good growth coming through for a lot of those commodities in the next 6 months. And all of the commodity names has been sold off aggressively during this reporting season. So we see good entry point into that space. Much rather to be staying with the bigger ones that are paying out big cash flow rather than the little one. The small ones, the problem with those ones is that one is operationally mine quality and all of that. Two is that it's highly leveraged. This little company used to lose money just a few years ago when iron ore prices struggled. So they highly leveraged, so they can move from lots of earnings into zero and negative. So you kind of want to avoid that sort of business in the environment where it's a little bit choppy, and stick with the big guys.
Got it. Thank you. So Grange Resources for you, Annette. Now the next company on the list is an interesting one. This one's for Craig. So amongst all of the tech names, the BNPLs, the Appins of the world, the WiseTech Globals, good old Dicker Data often gets overlooked. It's been around for a long time. It continues to make a lot of money, even in some pretty tough operating conditions. Interim dividend of 9 cents per share, total dividends 19.5 cents a piece. What do you make of Dicker Data? Jun Bei, we'll start with you.
Yeah, look, Dicker Data, it actually looks quite interesting. You're right. It's been listed for a very long time. It's got a good exposure, and exposure is really the continuing digitization of our economy, right? So lots of parts of the industry are, putting in more digital devices, especially COVID has really speed up that process and moving things into, cloud and the like. So it is very high quality, has a very long track record of delivering growth, and its return on capital is very high as well. So we do like this business. Market cap has actually got to, $1.2 billion, and recently made a really good acquisition, seems very accretive. So we like this business. It's a buy for us.
It's a buy. That's an interesting one. And I think as well, Carl, throw in that it's still founder led and run. What do you make of Dicker Data by the charts?
Yeah, the chart has taken a bit of a hit today on the back of, funny you mentioned the founder David Dicker. So he has announced yesterday after the results came out that he's going to sell another $42 million worth of shares. And he said, look, that's the only one for this year. The rest of it is still in escrow. And it's fully underwritten at $15.40 a share. That was below the share price post announcement. So we've seen a pullback in the shares today. So viewers are wondering why it's down so much today. It's actually not to do with the results. It's more to do with David Dicker selling out.
Is that a red flag for you, Carl? I mean, we always talk about that being a red flag because he's been in it for a very long time. In fairness.
Yeah, look, he has. I mean, he's obviously the founder of the business, and it is his baby. But at the end of the day, you can't. The business needs to survive and move on without you at some stage. And let's be realistic. And I think he doesn't draw a salary. So you've got to remember, this is quite unique for a CEO. He doesn't draw a salary. He has to get the money some other way. So look, I don't begrudge him doing this, but markets always get a bit nervous when these events occur. So, but apart from that, the chart looks very, very strong. I'm just checking my notes here. It's one we've had to buy for a very long time. In fact, just look at 20th of August was our first buy on it. It looked like tremendously, fantastically amazing value there. I must admit now, with the stock roughly double that price, it's not looking as great value. They had a huge boom out of COVID, a major COVID winner, but we are just starting to see some of that sales growth just starting to slow. I still think it's going to grow, and I still think it's a great, solid business, but I'm not as excited about it as I am here on a valuation basis. I think the chart is telling you to hold, but with today's pullback, I need a little bit more information as to how the market responds to that before I could confidently say buy a pullback at this stage. So it's definitely hold if you've got it, and just let's see a little bit more price action from today's announcement before you buy.
I thought it was going to go in the portfolio. Yeah, go ahead, Jun Bei.
Yeah, I think thinking of your daughter when you talk to me, that's a good sign. Look, I think it's because last night the block trade of this and the founder, right? So that normally dilutes the return a little bit the next day. So there's a little bit to wash through. That's kind of what the price action is today.
Good, got it. Number 8 on the list, giving you guys a time call, 1-300 Smiles. Potential change of control happening here, Carl. What do you make of it?
Yeah, well, I think we could do this one pretty quickly because as far as I can tell, this looks like a done deal. So we've got Abana Healthcare Group, which is in theory a New Zealand dental group, is looking to buy all of the non-founder shares. So about 84% of the business. The founders have agreed to retain the other 26% and stay with the business. Abano itself was purchased late last year by BGH Capital and the Ontario Teachers Pension Plan Board. So they're really the true owners. I can't see how this is not going to happen. Unless the mum and dad shareholders say we don't want it to. We had a fair value target about 7 or 8% higher than the $8 that's being bid. So I think given the certainty and the ability to go do something better, because let's face it, the stock wasn't doing a whole lot before that and the chart was very, very flat. I think you would take it and you'd go find something else better to do with the money. So it's definitely not a buy by any stretch of the imagination. It's a hold and let it play out.
Yeah. Jun Bei, do you agree?
Yeah, I'm the same. I think, it acts more like a cash box. Your return sitting here is very, very little now. So you get to sell it and put it into something else.
Got it. My sister contributes to the Ontario Teachers Pension Plan, so it looks like she just bought herself a little piece of a company. All right, stock number 9 on the list, Cromwell Property Group for Rob. It also reported this week a stat profit of $308 million. It's a fund. It's a REIT, essentially. What do you think, Carl?
Yeah, it's a bit of an odd rate. You're getting some Italian assets, you're getting some Polish assets, you're getting some Australian assets. They're looking to divest some of those European assets. But ironically, that's probably where the growth is going to come from as, the European economy rebounds. It's probably going to rebound quicker than anything that's going to happen over here with our current lockdowns. It's an interesting business. It's not expensive. I've got it sort of fair value target of about $1.02, which gives it about 10 to 12% upside. It's got a net tangible asset backing of 102, 7% unfranked yield, which is, even though it's unfranked, it's still a pretty good yield. The chart is pretty much flatline, stuck in the middle. Let me get to the point here. Look, I think if you had it and you're an income investor, and I always say you've got to find the right stocks for the right person. So if you're that income investor, you want stability, something that you're not going to wake up tomorrow and it's half price, I think you would hold it. I think if you're looking for a business that is growing its earnings and going to continue to do so it's at a great price and with a great chart, this is probably not the one.
Got it. Jun Bei, do you feel any more passion for Cromwell Property Group than Carl there?
I try, but it's very difficult. I think it's one of those property trusts that kind of stuck in the middle at the moment. So, two reasons you buy property trust. One is that, for the business that growing really well, like they have exposure to the industrial properties and the like, things like Goodman Group or Charter Hall, those managers, where the earnings growing and they're launching more fund, they're making more money, and there's a lot of growth. So, that's one end of it, but they're super expensive. And the other end of why you would buy is that the super cheap stuff, things like the shopping centers that's been completely decimated in terms of earnings, and or Unibail, the shopping center there in Europe and things. So and they're very cheap. So these are the two reasons of why you want to be there. And this company is somewhere in between. And it's not exciting, not much growth, and it's not that cheap or cheaper, but it's not that cheap. So I probably wouldn't put my money in there.
Got it. Thank you. Now, Appen. We need to talk about Appen. This was a market darling, not too long ago in the grand scheme of things, but boy, have the fortunes changed, particularly through the pandemic. This is Appen that I'm speaking of. Revenues down yesterday, got hammered off the back of the result, Jun Bei. This isn't a downgrade cycle. Or do you see value in some way emerging if you believe fundamentally in the business and that they won't be wiped out by competition? Jun Bei.
Yeah, look, I think it certainly is on the verge of being called, whether there's anything fundamental wrong with the business, because it can't be just the COVID disruption. The company has downgraded many times. Actually, during COVID period, it was a big beneficiary, but when the earning comes, there was a lot of disappointment, and then the management has continuously downgraded over the last 12 months. Now, we thought this result, because companies already downgraded before heading into this result, they still managed to come in and say that the earnings guidance will continue to be the lower end, and which is going to be very difficult to achieve over the next 6 months, because that simply means next 6 months needs to jump significantly in terms of growth. So it's very difficult for them to achieve, and for them to properly articulate how they're going to get back on track. I think there is even a bit of nervousness about the CEO and CFO, just given amount of downgrade that's come through. So look, I would absolutely be avoiding this one at this point. It has come off a lot, but we don't know. Remember, this is a contractor for the Googles and Facebook. So even though its earning is very linked to the cloud growth and things, but it is a contractor. So remember, contractor means that the margins will be under pressure if you can't sustain your level of expertise. And Google and Facebook are spending less on this sort of services, and they're automating a lot more. So what does that mean? That means a tipping point for, maybe they don't need that much service anymore. The margin then will be under pressure. So there's a lot of unanswered questions. We need to see it over the next 6 months, but certainly avoid for now.
Avoid from Jun Bei, because Appen actually does have human beings behind it. It's not some magical, technology that takes everything off into the cloud. And Facebook and the like have said they can probably do it, well, if not better, they could probably do it in-house for cheaper. So this is a top left, bottom right chart, even on our crude charts, and to my untrained eye, Carl. Or is there a price for everything?
Look, yeah, there is. I love that, Nadine. I think I'm going to start a company called Magical Technology that takes stuff to the cloud. I reckon it would go gangbusters, just between you and me in this day and age. I'll put it on TikTok. Now, back to the serious stuff of Appen. And yeah, I think there's a saying, is it fool me once, shame on you, fool me twice, shame on me. And management has through this downgrade cycle has continuously been overly optimistic about Appen's prospects, and the market is continually disappointed when those results come out. And I think what we're seeing yesterday and today is, I don't think the market's got any more patience for management and their optimism. And even whilst downgrading or narrowing their earnings guidance range to the bottom of that range, they're still saying, it's second half, guys. It's all about the second half, and then the revenue's coming. And the market's just not believing it. And the problem with Appen, and I know there are a lot of people hold Appen because they bought it after the dip and it just keeps dipping. That's a faulty strategy. But for the people who are holding and wondering where this turnaround is going to come, the problem is that a lot of those big US tech companies, they're starting to do a lot of this themselves, and they're pulling back from Appen. Now, Appen is making that up from their other markets, particularly in China and some other enterprises. So that's the good news. But this transition could take a couple of FYs. So yes, I think there's going to be a value proposition for this business soon, and I think there is value in the business. But I just think, looking at that chart, the other old saying is "Don't catch the falling knife." So it could. I'll give you a number where it could go. This is frightening here. This is a really important level. If it breaks this, the next level isn't down until 6. So I'm a little bit concerned. $10, big round number. If it gets below that, it's very worrying.
That is Appen for you, Scott. Not a happy tale. You guys, thank you so much for all of your insights, for your time this afternoon. It's always great to have you both with us. We very much appreciate it. Jun Bei Liu from Tribeca Investment Partners and Carl Capolingua from ThinkMarkets.
Thanks, Nadine.
Thank you so much. It's great to be here. Thank you.
Thank you. I will quickly, I know you just heard it, but I'll just quickly sum that up for you. 6, it is a hold for Carl. It is an avoid for Jun Bei. She says stick with the big ones, the big boys in the iron ore space. It is a buy for Data from Jun Bei. It is a hold for Carl, both though exercising a little bit of caution given the fact that we did see the founder and CEO sell a whole huge chunk. Now for 1-300 Smiles, just wait for this takeover to play out. In Carl's view, it's a sell for Jun Bei. Get your money, go someplace else. Cromwell Property Group, couldn't get either of them very excited. Not bad, not good. It's a hold for both. And Appen, it's definitely an avoid. Big problems there. You've just heard the two talk about it themselves. Listen, it's been great to have you along for the ride as well. If you would like us to cover a company for you, you can email us at thecall@ausbiz.com.au, or you can tweet to us, however you want to get a hold of us. We're usually available. Gemma Dale is up next. She will be talking about what traders have done in reaction to this week's results. So interesting to find out what's gone through the NAB Trade platform. And don't forget, we'll continue to bring you right to the corner office. We have Craig Scroggy from Next TC in the next hour. We've got Barry Irvin, Bega Cheese at 1:30, and rounding out a massive week, Wesfarmers MD Rob Scott after 3:30. It all continues after this very short break. Don't go anywhere.
I'm Cara Ordway and you are watching The Trade.
That's a proper double bottom. You really need to respect that level.
You need to really understand what you're doing, what your objectives are.
It's all right getting into something, but how are you going to get out?
Well, the devil is all in the detail when it comes to chart analysis.
You've got to look to different currencies.
The Trade is brought to you by markets.com. The world of financial markets, your way. Make the switch today.